On today's Hashi, I'm discussing Ivy Zelman's insights on builders, affordability, and capital gains, the impact of the Moody's downgrade, and Q1 home price growth. All the data's in. Today is Tuesday, May 20, 2025. I'm Byron Lazine, and the hot sheet starts now. Live from Naples, Florida. Happy to be here, jumping out of the BAMX members only role play. I think a bunch of you guys were in there. Jason was in there. I see Dawn. I saw Dawn in there. Dawn was in there. So great to see you guys over there. Let me know where you're tuning in from today, wherever you may be. Let us know in the live chat. Let's connect, make better connections there, where you're tuning in live from. All right. A lot going on here. Ivy Zelman's been active. I mean, I've seen like 6-9 months at a time where I don't hear from Ivy publicly. You know, she has some really expensive but robust reporting with Zelman and Associates, but she's been getting out there lately. Hey, when the economy is a little stagnant, Jamie Dimon just said his stagflation meter is up. He just said that yesterday, Jamie Dimon from JP Morgan. But when the economy's stagnant, it doesn't feel good. There's not as much easy. Maybe she's getting out there because she's like, hey, I got to drive more business to Zelman and Associate. Makes sense. Like, hey, increase the eyeballs when things aren't going your way, or the market certainly isn't supporting that. So she's been out there lately. She was just on CNBC Squawk Box, and she's talking about affordability, talking about builders right now, talking about what you should do on investments in real estate. People ask that question all the time. Where should I invest my money? It's a real question. She's got an answer for it. Single family rentals. She talks about that. And so capital gains, higher mortgage rates. Let's get into all of it. I'd like to start with the builders. We talked about builder confidence yesterday. If you missed the hot sheet, you can always catch the replay either right here on YouTube, or the replays go up on Spotify and Apple. We post the replay on all three. So you get it. If you want to check out yesterday's, it's on there. Builder confidence, it's lowest point in quite some time. That their confidence continues to shrink because their traffic, the foot traffic for builders, it's really low. It was at a 23. Okay. That's out of a scale of 100. The foot traffic, builders, they're not pleased with it. Okay. So when they do a move forward look on how confident they are, if you don't have bodies in your model home, you're not feeling very good about your ability to sell into the future. And that's where they're at, especially in the markets where the national home builders have built. That's where inventory is piling up the most. Okay. And we're going to see, we looked at inventory yesterday too. We're going to see more of it this year. Okay. Inventory stacking up creates a lot of opportunity for the agents out there to be extremely valuable in the respective marketplaces. When inventory goes up, confusion goes up. A stagnant economy creates confusion, creates hesitation, gets people stuck. And they need a professional more than ever in a changing market like this. So builder confidence we know is low. Let's jump to Ivy Zelman there, Haley, and see what she says about builders and how they're feeling.
Morning.
What jumps out to you about the latest data, including, as Diana references, really bad builder confidence numbers yesterday?
Well, actually, the single family numbers were not surprising at all. In fact, they were in line with our expectations. I think the builders are really challenged right now. Demand is definitely weakened, predominantly entry-level demand, especially out in the tertiary areas. I think the pullback is expected. The cost of land is not abated. Builders are not in a position to raise prices. So frankly, pulling back on activity makes sense. Whereas in multifamily, given the fact that renters are staying in place longer, as Diana indicated, we've seen rent inflation start to come back to markets where there hadn't been a lot of supply. The Sun Belt in the U.S. is where the supply was the greatest. In other parts of the country, we're seeing rents that are back in the mid-single, even 6% range. So I think the Sun Belt's lagging, but the optimism is that given the lack of affordability in single family, we're going to see renters stay in place longer, and therefore absorptions for demand will remain very robust. So we're seeing more activity, more developers thinking it's a good opportunity to come to the market now, given the lull in development that had occurred the last 2 years.
So, I mean, one thing, Ivy, I love listening to Ivy. Well, one thing to really pull from that, renters are going to stay in place longer. Does that also translate into, to me, it does, homeowners sitting on 3 interest rate, even though they don't want to stay in the house. They want a new house. They need more space. Are they going to stay there longer? Yeah. This kind of theme that we've been living through where people are staying in place longer, just based on the affordability of their other options and interest rate. We popped 7 yesterday. Okay. We're up over 7 again. Rates higher for longer. Yeah, I think so. I mean, I'm rooting for Danielle Hale and Realtor.com prediction that we can get into 6 territory by the end. But it's Memorial Day weekend this weekend. Can you believe that? And we've been hovering around 7, and now we're up over 7. The rates higher for longer is a real thing. Okay. Higher for longer, staying in place for longer. Now, when these rates move down, watch out for a market that, runs wild. Outside of some deep recession happening before that, if the soft landing by the Fed is pulled off, if the tariff landing is pulled off, trade war landings, if you get all these things to come together, the Fed's plan on inflation, the administration's plan on deregulation and signing big deals with countries to bring jobs back and kind of win the trade. If all these things come together at the perfect time, and you look back in a year, 2 years, think midterms. You get to midterms in a year and a half, and the economy is cranking, and you get rates to move down to what some of those forward-looking projections are to 6%. You're going to see a lot more transactions than you're used to right now. Now, I'm just saying, if all of that kind of takes place, all these people that are staying for longer, to me, hey, over the next 12 months, yeah, they're going to stay in place. All of a sudden, they come out of the woodwork and they're ready to transact. And you could see in a situation, 2020, end of 2027, where things just really are crazy. A super boom at the end of this decade in terms of transactions. Could happen. That's one of the scenarios that could play out. There's other scenarios that can play out too, but that's one that can certainly play out. Let's go to minute 19 here, Haley. Let's talk about long-term investors, how they should be thinking in Ivy's eyes.
Way in longer term. Not to be like overly tactical about this, but do you kind of get into the ways that investors could play these trends or no?
Well, at this point, the builders have rallied back after having pulled back pretty substantially in the fears of tariffs and uncertainties. What I would say is right now, if you're an investor looking to be long housing, I think that you probably would rather be in single family rental, multifamily, given that we are really at trough levels of rent. Coming off of 24 was trough, and we do see reacceleration in the rental market, but we think that the for sale market, at least on the new construction side, will remain pretty challenged here. So probably be more patient putting new money to work.
Yeah.
I always wondered
there's high inventory. We'll go to 2 minutes next, Haley, so you can get that ready. But there's high inventory where a lot of these folk, the national home builders have built. Putting more inventory doesn't solve the problem. There's high months of inventory for new construction. It's almost at 9. It's up over 8 months. That's a buyer's market. You don't want to keep pushing inventory into a buyer's market. You're going to continue to see the home builders slow down. Ivy bullish on on rents. So, buying single family rentals, buying into multifamily. She's bullish on it. I'm bullish on it in location specific. Okay. I don't love the Airbnb wave. Never have. I don't love, buying, 2-unit buildings where there's a whole bunch, Tampa. I don't love it where there's a whole bunch of new construction multifamily. I like location specific on rentals. I like location specific on everything. It really, you get down markets. I'm looking around here in Florida and people are wondering why their house isn't selling. Well, you're in a community with everybody at the same floor plan and 15% of the community is listed. It's not special. It's not unique. Location always matters. It can be a community located in a great spot, but you're not unique to your competition. So location is always the variable for protecting your investment. Let's go to, she had some thoughts on, you see it all the time. If you go on X, formerly Twitter, if you go on Instagram, if you go on TikTok, you see clips about this all the time. Now, you'll even see politicians misinformed. You'll see people on Congress very misinformed on this. Hey, the institutional buyer, Wall Street, they're buying all the homes. They own it all. I know somebody on Instagram. I know him personally. He drives fear into this all the time, that all the homes are owned by institutional. Wall Street's buying them up. You're not going to be able to buy a home pretty soon because they'll own them all. Ivy has some thoughts on this political and culture scrutiny on single family rentals, specifically who's buying them all.
I always wonder, though, if the single family rental stocks get political pressure on them, right? I mean, they're commonly brought up as the contributing to the reason why home prices have gone up, why rents have gone up. It's the Wall Street landlords and all the rest of it. So is there political risk in these names?
I think the political risk has been out there for quite some time, and I think it's stabilized. But keep in mind that the institutional investors account for less than 2% of total single-family rental holdings. It's really the mom and pops that dominate that market. So I think that the political aspects the politicians don't fully understand that. And there's actually been talk, which would make a lot of sense. At least there was a bill proposed that all the investors, the mom and pops that own homes today, how do we get them to sell them so that first-time buyers can have more access to affordable housing? Problem is they have to pay capital gains after significant home price inflation. Maybe if we eliminated the capital gains, if they sold those homes to first-time buyers, there would be a lot more inventory in the market.
Do you think something like that would come to pass?
So this bill that she's talking about, Haley.
There was a bill.
This bill that she's talking about, NAR was actually behind this bill. I'm behind this bill. We've talked about it here. You can drop off and then get 336 ready. But this is one of the things. I don't know how much leverage NAR has at this point. I mean, like NAR might have the, if they're trying to get a rock out of the ground, they're probably using silverware instead of a pitchfork at this point with the type of leverage that they have. But they were behind, to give them some credit, they were behind this bill. I'm certainly behind it. Hey, you own 4 houses. But you just don't want to cash out of the 3 rentals. Mom and pop investor in whatever town, you don't want to get rid of the 3 rentals. Hey, take cap gains away. Okay, take the capital gains away from them so they can go and cash out of some of these and tie it to buying. If you want to tie it to first time home buyer, that's fine with me. I got no problem with it. But what she was saying before, like, hey, the politicians don't get it. Less than 2% of total single family rentals are institutional buyers. Okay. Listen, institutional investors are 1,000 homes and up. Okay. So I know mom and pop investors in a certain town, they own 90 doors. I know someone I graduated high school with. Okay. He waited till the market crashed because he was in college while I was buying homes. I crashed out. he starts buying basically the homes I crash out on, he's got 90 or 100 tours now. And listen, I don't consider that some type of, institutional investor. I consider that a smart dude who basically is a mom and pop investor who's providing quality rents to people in his community. Okay. So the politicians don't understand it, that the crybabies on IG and on TikTok that investors are buying up all the homes, they don't get it. Wall Street owns less than 2%. Okay. If you add a 0 to the 2, we got a problem, but you're not going to see it. They're not going to just go out there and overpay for everybody's homes. You already see price resistance with Wall Street. They've been buying a lot less homes. You want to get more of that inventory out there, make it attractive. Make it attractive. Oh, well, the people that bought all the homes before COVID, they're going to win. They're going to cash out. Yeah. You get what you deserve. If you invest in real estate and you wait, you get money. Okay. You get what you deserve, and they deserve it. And if you want to, if the politicians were serious about getting inventory out, they'd create some kind of opportunity like NAR backed, and Ivy Zelman is talking about mortgage rates at the 336. Let's listen to Ivy's final thoughts here on Squawk Box and what she thinks about rates.
No, it's an excellent point. With broad mortgage rates now back up towards 7%, it was a little bit of an unanticipated development,
Over
here as
today.
we are in mid-May. What impact is that having?
The market's really slow. I mean, the affordability is extremely stretched. We had so much demand during COVID. I call it pull forward. We saw normalizing demand. So I think that the market is just fatigued, coupled with so much uncertainty, with affordability being obviously stretched. I think buyers are stepping to the sidelines. Move up had been really resilient, but in the last 30 to 60 days, move up is starting to show some slowing. And there are pockets in the country that are more under pressure than others, where production builders are very prevalent, predominantly Florida and Texas markets. But I was in Denver this week, and Denver is really seeing pressure too. And that's combination of the buyers that are stepping to sidelines, the lack of affordability, and just concern that builders, don't have pricing power, and incentives such as mortgage rate buydowns are not really incrementally moving the needle as much as they had been.
Yeah. Okay. Listen, the fatigue is going to continue. Punchline: fatigue is going to continue, which means uncertainty, which means people take longer to make decisions. When the rates move down, if the economy is strong at that point, that fatigue is going to be far in the rearview mirror, and there's going to be a lot of activity. I mean, listen, you'll be running maybe faster than you ran, second half of the year 2020 and 2021. The movement and the growth on transactions could be that explosive because people have been fatigued for so long. All right, Moody's is fatigued with the U.S. Credit rating. They moved it down. This was expected. Talked about it a little bit yesterday. Other agency, this isn't like news. This isn't a shocker. There have been other agencies. Moody's getting in line with basically every other agency that said, the U.S. has too much debt. I mean, I don't understand when everybody wants to resist reduction of debt. It doesn't make sense to me. I talked about it all of 2024. We got too much debt. It's not an attractive place to invest when you have this much debt, and your economic growth in 2024 was all based on government hiring. You can't keep kicking the can down the road. And that's what Moody's is saying. Okay. We got a rising debt and they want to rise, politicians always want to just raise the debt ceiling. Doesn't work that way. Not when your growth is just being eaten alive by interest payments. Okay. At some point, if you're not going to outgrow it, if you're not going to create more and more revenue, which is difficult in this global economic climate, then and it's been difficult for years, then you've got to reduce the expenses. If you go on the internet, A lot of people don't like Doge, but the whole theory behind that was like, are we wasting any money? I mean, we got a pretty big budget. Could you make the argument that some of this money is being wasted? So the downgrade brings Moody in line with other major agencies. S&P, Standard & Poor downgraded U.S. from AAA to AA+. I mean, if you ever seen the movie The Big Short, you know these ratings are kind of silly at times. I mean, there was AAA on the banking industry before we weren't. Okay. There's if you ever watched Billions and Taylor goes into the agency rating and she basically manipulates the ratings in the Showtime show Billions. Like, do you think these agencies have played it straight and narrow? Though they weren't playing it straight and narrow during the mortgage crisis, but Moody's goes from AAA down to AA1, which is AA plus, like Standard & Poor's. Fitch ratings downgraded already AAA to AA plus. What do I actually care about here? Okay. I care about what's the impact going to be on the 10-year? What's the impact going to be on the 30-year? This is we're focused on housing here. Not to be selfish, but it is what it is. Logan Motoshami over at Housing Wire says the timing of this downgrade, it was intentional, as the budget proposed by Republicans is set to increase national debt. This budget's already been, I think, a Senate committee said no. We're not going to move forward. So this budget, which has been proposed, it continues to have work on it. But listen, you want to increase the debt, but at the same time, I'm against increasing the debt. And I think it's pretty clear where I stand. The 10-year has reacted negatively. That's why we're at a 7% 30-year fix. 10 years been up over 4.5. It's just under today. Logan over at HW says the situation differs from corporate debt, where a downgrade to junk status would compel firms or the company itself to take action. The hope here is that the actual government will take some action. What's been happening with the economy and the Federal Reserve during the last two downgrades is more critical for the 10-year yield and its immediate reactions than the downgrades themselves. Yeah, the downgrade doesn't mean as much as like how high is the 10-year going to go? How high are rates going to go with these downgrades? What ultimately matters, like, okay, what's the Fed now going to do? You got to downgrade. What's the Fed policy going to be? And how's that going to impact these rates moving forward? We've seen the reaction here in short term on the 10-year. Okay. It's moved up, no question about it. And we look at it today. I'll just hit a refresh. We were under 4.5. We're not. Now we're back up to 4.5. Last 3 months, this is the high point in the last 90 days. Okay. That's the last 6 months. You go the last 90. This is the high point on the 10-year. So 4.5, this isn't great news. Okay. What could bring it down? Labor breaking. And we haven't seen that. We're not rooting for that. We're not rooting for people to lose their jobs. But if you're really looking for what could bring it down, that's the piece of the puzzle there. So 10-year moves up. We'll see what the Fed does. Right now, CME Group is saying, hey, 91% chance. I'll hit a quick refresh on their forward-looking. 94% chance the Fed doesn't make a move again at the next meeting, which is now just under 30 days. All right, we've got all of quarter one data in from National Association of Realtors, and we've got Q1 pricing. What does Q1 look like at a whole as we led into the spring market? And according to NAR, more than 80% of metro areas saw price increases in Q1. Single-family existing home sales climbed 83% in 189 of 228 metros in the first quarter. Okay, it was 89% in Q4. So we are seeing that downward pressure due to increasing inventory in certain markets have an impact, but this is still a big chunk. The national median single-family existing home sale price rose 3.4% as builders' median single-family home prices are moving down. It rose 3.4% from a year ago to 402,300. 26 markets experienced double-digit annual price appreciation. Those would not be in those Sunbelt states that Ivy Zelman was talking about. And expect, I think, more downward pressure where you have inventory, and expect the markets where you don't have a lot of downward pressure to continue to move up. Northeast and these types of markets here. Here are the largest percent gains according to NAR. I mean, they're all kind of chunked up there in the Northeast for quarter 1. New York, Pennsylvania, Jersey. I'm actually surprised that there's no CT in there. You saw Montgomery, Alabama, 230,000. Some of these very affordable area. Gulf Coast has been getting beaten up, and so at some point it's like getting beat up for too long. You got $230,000 community in Mississippi and Montgomery, Alabama, 230,000. They saw double digits. Outside of that, it's really all where the inventory is low. So inventory is low or price is low. That's where you saw the biggest gains in home price appreciation in quarter 1. And I'd expect more of that to be the same this remaining year. Inventory low, or you've just got such a good deal below cost of replacement. We heard that from JP Morgan Chase a couple of months ago. Like, if the cost of replacement is well above what I can buy the house, I'm buying the house. Okay, that's just one way to think about that. All right, 30-year fix yesterday did not help us here to close out this spring market. Yesterday it did hit 7%. There was a second reading. It came back at 6.99. We're essentially at 7% here. So we'll see where it goes today. 10-year still up over 4.5. The spread has improved. That's very helpful. We'd be up over 7.5 if not for the spread normalizing. All right, have a real word pod up later today. I know we missed last week with some of the issues that I was faced with, but we'll have a real word pod up here on the YouTube channel later today. Make sure you subscribe to the YouTube channel so you get notification. Hit the notification bell so you get notifications on this show going live when we post new content like today's real word. Posted a video from Sharon yesterday. Just a kind of a one-off video Sharon did for the BAM YouTube channel. Go check that out if you haven't already. And if you're looking for tomorrow a webinar, we've got a free webinar for you tomorrow on how to win every buyer. Okay, the single best buyer presentation, the psychology behind what buyers really want to know, pre-approval funding strategy. So have a strategy around the finances as well as strategy for the follow-up. That's what you're going to get out of it. Those three things. Webinar link is down below. And so that's open to everybody, members or BAMX members or the public. That webinar is available to all of you. And so hope to see you on that. And I'll see you on the real world later today. Until then, of course, toodaloo.